Thank you, Jason. Ladies, gentlemen, good morning. So this is what it means to have the adults back in charge. As Jason has said, yesterday was Jeremy Hunt's first budget proper. I mean, he did have a period acting as Liz Truss's carer towards the end of last year, as you might remember. But for me, it was exactly as expected. Dullness is a virtue. Philip Hammond Mark II. Maybe that's precisely what the country wants at this stage. But my view was that there weren't any particularly big ideas, no particularly big vision. Hunt's priority was growth. And the statement I found was pretty wide-ranging, fairly technocratic tinkering around edges, staying on safe ground. Staying on the safe ground of the Prime Minister's priorities and sort of reheating his Bloomberg speech from January earlier in the year. The soundbite was 4 E's, enterprise, education, employment and everywhere, which is the one I struggled a bit to get my head around. But that was the common thread. He didn't get the memo. Soundbites normally come in 3s, don't they? Get Brexit done, education, education, education. He had 4 E's. Exciting didn't make his list, but Tim Farron's tweet during the day, which is on the screen there, did make me chuckle about the number of these. Never mind. Let us try and insert some excitement this morning and take the risk of being what Mr. Hunt called declinist. We're going to talk about some macro stuff, and this is the journey I'm going to take us through. I'm going to start global, I'm going to finish anecdotal, and then try to pull it all together with a little bit on future outlook. I've got about 15 minutes, so I will crack on with global. And what I want to talk about here is the USA and China, or perhaps you could say us and China, as I put it, because currently we seem to look more towards the Atlantic than the Pacific. And if there's one slide that pretty much explains the context for everything global, it's this one. It's the share of the global GDP pie, global output. So the USA and China are the only 2 economies that can really influence the world by themselves, but neither can control the world economy by itself. The next smallest one in the yellow is Japan, which is about 4.2% of that slice. Germany is about 4%, and then the UK is 3.1%. So mere noise in the scheme of things. So the USA and China are a bit like 2 directors on the board that could run everything if they worked together, but they won't work together because they hate each other so much. And this dynamic and power tension is worth exploring a little bit because I think it's at the heart of everything going on. First, the USA. So the USA dominated by technology, pharmaceuticals, and financial services. You see, soundbites come in 3s. I've called it tech, tablets, and tellers because I wanted the alliteration on T. I'm sure you've all read about Silicon Valley Bank. It's quite a timely case study because it intersects all of those 3 industries. And to understand Silicon Valley Bank, you need to understand that the US economy is dominated by debt. $32 trillion to be precise, 20% of which, about $6 trillion, printed since COVID. Now, those of you that have been at these events before know I always quote Milton Friedman, and he said that inflation everywhere always is a monetary phenomenon. So this is a debasing of currency, which has led to high inflation, needs to be dealt with by raising interest rates. So that's what we're seeing now, and this in turn leads to market volatility. Silicon Valley Bank particularly exposed, particularly vulnerable, because it's exposed to a world of investments in intangible assets and intellectual property and assets of tech businesses and cash-burning businesses. You know, you can't sell an intangible asset at the car boot. Big players in my T's there, when I talk about tellers and financial services, Vanguard and BlackRock. It's interesting. They have fingers in every pie, including Silicon Valley Bank, and no doubt managing some of your pension funds here today. Have a look at their balance sheets after this event, because I have. It's quite interesting. Is this 2008 all over again? We'll have to wait and see, but there's worrying news emerging on the radio this morning. Credit Suisse. Credit Suisse is now basically a regional bank, an EU bank. It's no longer a global bank. Take a look at gold over the last couple of days and how that has rallied. So the overall issue with this sector, these tech tablets and tellers, is the old adage of investors. If you can't hold it tangibly, it's not really yours. As soon as you put money into the bank, you're subject to counterparty risk. And as soon as the market gets wind that something's up, you're dealing with a bank run. Liz Truss experienced a similar thing when the bond rates went through the roof towards the end of last year and the pension schemes made their margin calls. A run on the pension schemes was narrowly averted. So in summary, a characteristic of the US and Western economies like ours is focus on short-termism, no real thought to decisions over the long run. Time spent on TikTok gimmicks, no time spent on serious productivity improvement. It's worth just focusing on Silicon Valley just a little bit. If you look at the $200 billion or so on their December balance sheet, you can see $13 billion is in ready cash. The rest in bonds, held to maturity, not marked to market. The problem with all banks is that they lend long and they borrow short. They borrow from people like you and me, from businesses that need to access the accounts immediately. When customers get wind of a problem, we want our money out and suddenly there is no liquidity. Keep an eye on this as a Trojan horse, central bank digital currencies. And I can talk more about that afterwards if you can find me. China has other challenges, other problems. China's basically the world's miner, producer, manufacturer, and facilitator of posting plastic stuff to our doors in the West. Their issue is a demographic time bomb. 1.5 billion people, but negative population growth. Decreasing tax take, decreasing pension contributions. So China's challenge is that it's going to get old before it gets rich. But there's no short-termism there. Xi Jinping is pretty much emperor for life. So China's about authoritarianism, about control, about trying to plan everything, right down to the colour of its citizens' underwear. And this chart from the Financial Times caught my eye because it shows how Chinese transparency has changed since Xi Jinping became the leader. He's dealt with some of these frailties in Orwell 1984 fashion by simply not publishing the statistics. So we don't really know what's going on there. But the reason I'm going on about this is because the US-China vying for global hegemony is fascinating. Who do we follow in the UK? It was China with Osborne and Cameron. It's moving towards the USA. We had the AUKUS deal signed and the thing on submarines earlier this week. What I do think is 2001 is a key date for both countries and therefore the world. Obviously, 9/11/2001 changed everything for the USA. What you might not realise is that 2001 was also the year that China was admitted to the World Trade Organization. So that's when globalization really started with a vengeance and China became the world's manufacturer. I don't have anything to say about defence and Ukraine today. It's my view that some of the issues we're seeing, tragic as they are on a personal level, are largely proxies for this global struggle. And the point I'm interested in is that this struggle brings with it inflationary and recessionary pressure. So how does all of this affect good old Blighty? Well, we now look more towards the US than China, as I said. But what does it mean for what Jeremy Hunt said yesterday? He made his presentation about growth, at least that's what he said. Look at the GDP growth for that period since that crucial year of 2001 when globalization started. You can see two notable shocks on that graph. The financial crash in 2008 and then, of course, COVID in 2020. If you average out GDP growth over that period, you basically come back to 0.2% on average. Essentially, if you add up the area under that graph, it sums to zero. Yesterday, the OBR predicted a negative 0.2 contraction for the year. And believe it or not, that was an upgrade from their forecast just a few months ago. That is then followed by, on average, over 5 years or so, 2% growth for the remainder of the forecast. So what their forecast is saying is there is not going to be any future shocks in that forecast period. For example, a collapse of Credit Suisse. Public sector net debt was 98.9% at the end of January. And the OBR said yesterday that this is going to increase to just over 100% at the end of this year, and then essentially stay there for the next 3 years. So debt is the highest it's been since the early 1960s. Debt is not coming down in any meaningful sense. And frankly, I think I'm going to stop presenting this slide because my partners are fed up with me moaning about debt, and it ain't going to change. But what I would like you to do is to indulge me with a thought experiment to illustrate my short-termism TikTok point. Imagine now a politician standing up in 2001 with this policy platform. We will grow GDP by 0.2% per annum. We will increase taxes as a share of GDP from 32% to 39%, the highest they've been since the war. We will increase public sector debt as a share of GDP from 28% to 99%. We will increase benefit claimants' count from 950,000 to 1.5 million. We will increase the cost of electricity in real terms by 106%. I looked that up yesterday. And all of this is to incentivize growth. That is incoherent. Yet all of those things happened, yes, some as a result of events, but also as a result of policy choices. The area under that GDP growth curve for 22 years is basically zero. Jeremy Hunt used the term declinist a lot yesterday. I don't think it's declinist to point this out. I think it's realistic, and it's a matter of historical record. As Churchill said, those that fail to learn from history are doomed to repeat it. Despite the growth rhetoric yesterday, I believe we must face the realistic facts, particularly with the prospect of a new administration in short order, as Jason has already mentioned. These all present recessionary pressures. It might not be a technical recession on a government mandarin's calculator, but certainly it is in terms of how we businesses feel it, how we see it on our books, and how all poorer we feel as individuals. Next, I turn to some macro stuff that's of most consequence to the employers that I'm speaking with in the region. Now, those of us in the private sector without the facility to go on strike, like my daughter's teacher, have all been having conversations with employees around pay and benefits in the current inflationary environment. What's interesting about this chart is that there are signs that the UK labour market is cooling down. Unemployment remains unchanged, but the number of vacancies, still above 1 million, as the Chancellor mentioned several times yesterday, fell significantly last quarter. The biggest indicator of this is wage growth. If you look at this graph, you can see the rise in average total pay fell to 5.7% between November last year and January this year. So it's on a downward trajectory. Adjusting for inflation, real terms, wages fell by 3.2%. So we might not be in recession, but people are feeling poorer. It's cooling. No doubt a lot of this will shape the Bank of England Monetary Committee when they meet on the 23rd of March to talk about interest rates. It's more likely, because of this, that they'll hold at 4% or at least proceed with a smaller rate hike than we saw over the course of last year. Another centrepiece yesterday was around energy. Energy is relevant to everyone in the region in terms of cost of living, but also in terms of infrastructure development that we're all aware of. This is quite an interesting chart, which again draws on my distinction between the USA and China. It's looking at change in consumption of CO2. We all know that growth, real growth in any economy, is reliant on abundant, cheap energy, and that's because it's a feature on the P&L of every business. I ask the question, how much of our energy costs are the result of net zero policy choices? How much really relate to other external factors? I thought what Jeremy Hunt said yesterday, dressing up nuclear as environmentally sustainable, was very interesting. and clearly very relevant for the east of England. Now, you might think I've been anecdotal already, but I'm going to be more anecdotal now. How does the budget chime with what we are actually seeing from the marketplace and at the coalface in our practice? I want to pick a few sectors that are crucially important to us in the East in terms of employment growth and productivity growth. So you see productivity growth on the y-axis there and employment growth on the x-axis. Manufacturing, agriculture, IT, technical score very highly as the growing industries. We track data every 6 months with our friends at DealSuite. And what DealSuite do is to anonymise and collate information from actual business sales by sector. The prices paid for the businesses are stated as a multiplier of those businesses' earnings. And you can see on this page that the multipliers vary widely by sector. What you can also see is overall, on average, multiples have declined by 0.3 between the first half of 2022 and the second half of 2022. That's what the data's showing us. They've gone from 5.4 to 5.1. That's not me saying this. This is what the market is saying. If I choose the three of the darling sectors of the east of England, what I can do is compare the average prices paid for such businesses. And with a little bit of mathematics, I can turn these multiples into a capitalization rate. So what this is doing is stating a return that an investor is expecting from a business purchase. Now, we know last year there were half a dozen interest rate rises, the Bank of England. So I need to use a bit more mathematics to turn this into a rough cost of capital. But you don't need to worry about that. In short, what this is showing us, the figures, the bottom right in bold, represent the additional risk that an equity investor is taking, a buyer is taking, between buying a business in the first half of the year versus buying a business in the second half of the year. Crudely, you can think about this as how much the buyer will have looked to reduce their price simply owing to the passage of time. And this data is being borne out by my team who are currently working on these sorts of transactions. These are the sorts of sentiments that they are feeding back. And we can catch up afterwards to talk more about the specifics of these, but you can see some of the sorts of things that they are saying. So what about the future outlook? The key OBR takeaways from yesterday. Technical recession avoided. Inflation expected to fall significantly. Historic GDP growth, that 2% level, anticipated in the future. But I think I've concluded that I'm not a declinist, I'm not an optimist, I'm a realist. And this is why. The Chancellor has the thinnest of fiscal headroom with his own rules. The revised forecast that allowed the technical recession to be avoided, when you drill into that, was only possible as a result of a higher than anticipated net migration figure to the UK. And what this means, where it's so tight like this, where the margins are so tight, a single event like the King's coronation or a teacher's strike can throw a quarter completely. On inflation, this forecast down from 10.7 to 2.9 by the end of the year, I've never seen such a significant forecast by the OBR. It's unprecedented in terms of the scale of that target. So I have some doubts about that. And that's also, if you trust the way that inflation is actually measured in this country, that's a whole other discussion. Again, we can talk about that if you're interested. And then finally, the new industries that are being relied upon to drive this growth, they really have an awful lot to do in an awfully short space of time. And I'm mindful that a number of those new industries are reliant on significant infrastructure development. And we all know how long that sort of stuff can take. So that's kind of my realistic view on the key takeaways from yesterday. I just want to end by saying that being a realist doesn't mean that you don't want it to work. It just means that you think it probably won't work. I hope we all want this to work. Thank you very much.